Welcome guys to today's teachings. This is Melody FS Academy, and if this is your first time of coming across this channel, please do well to subscribe, turn on the notification bell to get notified whenever we upload our weekly content. Okay, so in today's smart money concept trading model series, we are going to be looking at order flow shift. Okay, it's going to be in terms of breakup structure and shift in market structures. Okay, we're going to cover the difference between the breakup structures and shift in market structure, and we're going to talk a little bit about trading range. Okay, so now starting this series, when I actually started making the smart money concept trading model, I didn't really have a content a I didn't have a table of content in mind. Okay, so I'm actually making the series as we go. Okay, I'm coming up with the concepts. Okay, so now I'm coming up with each ideas for each series. Okay, more like coming up with different ideas on a daily basis for the model. Okay, so now we're going to be looking at breakup structure and shift in market structure. There's a big difference, and I know some of us are already familiar with that. Okay, so for those of us that are not really conversant with the idea, with the with the concept of market structure shift, this video is actually for you. Okay, so now if you are already familiar with the concept, you might want to stick around. Maybe you might grab one or two things from it. Okay, so let's get down to today's business. Let's get down. Now we are going to start with the definition, or probably a look into the meaning of breakup structure. Okay, so breakup structure is the indication of price going into an expansion or retracement phase. Okay, so now this would be a classical break of structure as an expansion. Okay, so this is break of structure as an expansion. As you can see, the market kept expanding lower. Okay, so this right here is a break of structure as an expansion. Okay, so then this is break of structure as a retracement. Okay, which is the last leg right here. Okay, so now we have this break of structure as expansion, then this break of structure, because this would be considered as a break of structure, but it is a break of structure as an expansion, sorry, as a retracement. Okay, so that is the two types of break of structures we have. Okay, we have the break of structure as an expansion, then the break of structure as a retracement. Then the trading range is going to come in next. Okay, but let's look at what a shift in market structure looks like. Okay, so a shift in market structure indicates a change in an underlying trend. Okay, so in other words, if this is in this example we have a bearish trend. Okay, we have an underlying trend as a bearish trend, right? So structure is bearish, and you can see we have these are breaks of structure, right? These are break of market structure. Then this is a shift in market structure. Okay, why is this a shift in market structure? Because an old short-term high that broke, okay, that breaks this low, that broke this short-term low was taken out. Okay, so now that when we get to the idea of trading ranges, you're going to understand it more. Okay, so notice that as price was drawing down, was trading downwards, notice that the short-term highs were all protected. Okay, back here price just retraced a bit and broke down. Okay, retraced a bit, broke down. Notice that the short-term highs are being protected, but a shift in market structure would would be a short-term. It can be an old high or old low being taken out. Okay, being violated. Okay, so in other words, this is a shift in market structure because we had an expansion lower, grabbed liquidity, and this short-term old high right here was taken out by this price leg. Okay, so this is a valid shift in market structure. Now the next thing we're going to be looking at is the trading range. Okay, trading range is the most recent swing high or swing low that broke or shifts market structure. Okay, so how do you identify your trading range? In this example, we have this this will be our trading range high to the point where the market starts retracing. Okay, the point at which the market starts retracement, goes into the retracement phase, that will be your range. Okay, so this is the range. This is the range we are looking at. Okay, now when the market takes out this old short-term low and breaks down lower, okay, and breaks lower to the downside, this will be your new range. Okay, so and your range, identification of your range easily will come in the way of understanding the swing low and swing high. Okay, so when the market, every time the market goes into a retracement phase, it's going to create this three candle pattern. Okay, it's going to create a candle with a high, a lower low, and a candle to the a higher candle to the right side of it. Okay, so creating this swing low. So when this three candle formation pattern comes up, that is an indication that a short-term retracement happened. The retracement could be short-term or it could be a long-term retracement. Okay, so this is an indication that a retracement happened right here. Okay, so we are going to look at that in the chart. Then whenever a retracement is about to happen from the upside, definitely we are going to see this swing high. Okay, so now how do we identify our range? How do we identify our range? We make reference to the swing high or swing low that breaks market structure. Okay, so the swing high, not just because within this retracement there are going to be many swing highs. Okay, right, there are going to be many swing highs. So how do you pick the swing high to be used as your range? Okay, how do you pick the swing high? So you will be more interested in the swing high that breaks structure to the downside, right? So that will be in form of this. So this will be the swing high that breaks this market structure right to the downside. Then this is the swing high that breaks structure to the downside. Okay, so this is your range. So once you don't move this range until this short-term low gets taken out, in the case of a downtrend. Okay, so we don't move our trading range high, we don't move this. Okay, when we are bearish, we only move our trading range high once this short-term low gets taken out. Okay, so when this is going to be my range until this short-term low is taken out, is violated right here. So then I can move my trading range from this high to this high, because this is the high that broke this short-term low. Okay, so now how do we know that a new range has formed? Is when we see this candle pattern. Okay, once you identify this candle pattern that forming at the extreme edge end of this range of this price leg. Okay, once this swing low begins to form down here, that is an indication that the market is moving into, or is about to move, or rather the market is going into a retracement phase. Okay, it can be a short-term retracement, or it can be a long-term retracement. Okay, what do I mean by short-term? You can just create this three candles pattern only and expand lower and continue expanding lower. Okay, so it can be a long-term or it can be a short-term retracement. Okay, so once this old low gets taken out, we move our trading range high to this low, to this high. Okay, so this becomes our new range. Okay, so that is one way of identifying your trading range and be able to spot a break of structure, or rather differentiate between a break of structure and a shift in market structure. Okay, so the break of structure that occurs within this range is known as the break of structure. Okay, whatever old highs that gets taken out inside of this range is a break of market structure. Okay, then but eventually in a downtrend, in this example, as you can see, if this old high gets taken out, okay, the high that broke this old low, okay, if this old short-term high eventually gets taken out, that will be viewed as a shift in market structure. Okay, so until this old high gets taken out, whatever break of structure that occur within this trading range low to this trading range high is known as a break of structure. Okay, so that is just that. All right, so now a break of structure as a retracement on the higher time frame. So when a break of structures happens, let's say this is the 4-hour time frame. So let's say this is the 4-hour time frame, okay, and we had this current trading range. All right, so when we have eventually, if there's going to be a retracement, there's going to be a breakup structure, right? There's going to be an old short-term high that's going to get taken out. Then most retail traders are going to view this as a shift in market structure, that the market is currently bullish right now, okay. But as smart money traders, we should be able to understand that this is just a retracement, okay, until this old high gets taken out. Until this old high gets taken out to the upside, that is when we can view this market to be bullish, okay. Otherwise, whatever happened between this trading range low and this trading range high is eventually a retracement, okay. So now that is why the idea of seeing a failure swing, sometimes I don't like anticipating a failure swing as a means of reversal, okay. I like seeing some run on liquidity. In other words, if this low was to likely go below this short-term low, this would then be viewed as our new trading range, okay. Let's say, for example, this old short-term high, okay, traded this old low, went below this old short-term low right here, okay. This will no longer be our trading range high, this will be our new trading range, okay. Once it goes below this old low and start retracing, this will then be viewed as our current trading range, okay. Then if this old high eventually gets taken out, okay, after trading below this old short-term low, that would then be viewed as a valid shift in market structure, okay. So that is just that. So on the higher time frame, is going to look like this. When we have an expansion, okay, when we have an expansion lower, in this example for a bearish trend, when we have an expansion lower, there's going to be a form of retracement, okay, and for that retracement to happen, there's going to be a form of breakup structure, right? So then we now understand that between this old high and this old low, this is just all retracement, okay. That is where the idea of using our fib to measure the range comes into play, okay. So we buy here, and although we are short, this gives birth or give room for counter trend trading opportunities, okay. So we're able to accumulate down here, move into premium, and look for a premium spectrum to sell to, okay, premium array to sell into, okay. So that is just that. So without the proper understanding of your trading range, using the fib is going to be kind of hard, and you're going to notice that maybe you thought this trend is currently bullish, okay. So you are going to read price wrong most of the time if you are unable to identify your current trading range, okay. So that is just that for that. All right, so going down into this price action,